Over the last 20 years, we've seen a few very successful examples of technology companies that were able to not only disrupt their industries, but create new products or markets. And in that process, they were able to deliver an impressive amount of wealth for their founders and their early on investors. Examples such as Facebook, Google, or even Amazon come to people's top of mind. However, one should never forget that the probability of success of any startup is extremely low. 7 or 8 out of 10 startup companies will fail. Maybe 1 or 2 break even, and only 1 is successful. As an investor, you need to remember that the probability of you losing 100% of your capital while backing a new company, startup, is extremely high. Amazon has been the exception for 3 main reasons. Number 1, the company has been very successful at reinventing itself over the last 20 years by fine-tuning their original business model while at the same time moving into new markets and successfully disrupting those new markets. Number 2, the market has been incredibly patient in allowing Amazon to reinvent itself, move into new markets, giving investors very low visibility on the future business. Even though Amazon comes to the top of mind of people as the ultimate online retailer, people overlook that today's profits come from a service or a product that Jeff Bezos only tapped into a decade ago, around 2007, when he came up with the idea of Amazon Web Services, which includes the cloud-based service. We as value investors believe that price is the most important variable while analyzing a new investment. Embedded in the price of a stock, there are a set of expectations. Those expectations include growth that the company or an asset can deliver over time, together with the risks associated with that company or business. Companies where the market has high expectations of growth will command a higher investment multiple, a high valuation multiple, with the expectation that eventually the earnings and cash flows that will be delivered by this company will justify the price that you're paying for that stock today. We believe that there's a component of risk to that, in the sense that growth is speculative in nature, because it's hard to predict and won't allow you for a margin of safety. Margin of safety is very important to our own process because it allows the investor to err on the side of cautious. Because of this reason, we in the value team prefer to look at companies within the technology sector in more mature markets. Companies that are out of fashion today or are perceived to be out of fashion today, but that were not out of fashion maybe a decade or 2 decades ago. Companies within the semiconductor segment or the computer manufacturers, or not so long ago, some of the software companies.